Well, it's hard to believe, but tax season is here once again already, and almost inevitably, there will be changes from last year, but it won't make things any less confusing. Today's guest has some advice on how to prepare your taxes and hopefully save some money along the way. Kent Prestage has decades of experience preparing taxes. He is the owner of Prestage Consulting and is also an instructor at Reeves College in Lethbridge. Great to have you on again with us, Kent.
Thanks for having me.
Absolutely. Okay, so first off, when do personal taxes need to be filed, and what is the penalty if you end up filing late?
Well, April 30th for most people. If you have a business, it's June 15th, but for most people, it's April 30th. And the penalties, you want to file on time. If you're late filing, it's a 5% penalty on the amount of tax that you still owe. And also, if you're late filing for a whole month, each additional month they add another 1% to it. And on top of that, the compound interest daily at 10% for this year. So you want to file on time, especially if you owe taxes.
Yeah, I was just going to say, and those fines are for if you are owing. If you're getting money back, there's not a penalty, right?
There's no fine if you're getting money back, except for, you'd rather have your money in your hands right now, I would
Yeah,
assume.
the
Yeah,
sooner the better, right? Make some
that's
summer
right.
plans with it. Why not?
Exactly. Yeah.
Okay, so Kent, many people today just use tax software to file their tax returns. So sometimes it might be worth hiring a tax professional, though, to do the preparation. So why is that?
Well, I'll just tell you a little story here. I had a client one time who bought his own tax software and he filed his own tax returns. And then, just for fun, he said, I want you to do my tax return for me. And I got $1,500 back more for him than he did on his own. And the difference was he didn't know what to claim. He didn't know what some of his exemptions were, didn't know what some of the credits were that he could claim, and he missed things. And it was actually $1,500 difference. So he was client for quite a few years. He then moved away, so he's
Okay.
not my client anymore. But certainly, it does tell you that you really software is great. It'll do the math for you, and it'll remind you about some things. But you still have to have a body of knowledge behind you, so you know what to claim.
Yeah, that was a good lesson for him, definitely, and for our viewers as well. So, Kent, ever since the COVID pandemic, there have been a lot more people working from home, and up until now, the CRA had a simplified method of
Yeah.
claiming home office expenses, but things have changed this year. So, can maybe you explain a little bit about what these changes are?
Sure. So the simplified method was if you were working at home during the pandemic, you were allowed to claim $2 a day up to a maximum of $500 for home expenses while you were working from home. This year, they did away with that. They went back to basically the old way that you would normally have had to have claimed those expenses. You'd have to have the company that you work for sign a 2200 form, a T2200, and that form is it allows you to claim expenses for working from home. Then now you have to keep track of all of your expenses. So let's say you set aside an office and it's 10% of your home, which is quite typical. Most people would take a bedroom and set it up as an office. And that's usually about 10% of your home. So you can claim 10% of your utilities, 10% of your interest, 10% of fire insurance, and any expenses that have to do with your home. You can also claim a cell phone and other expenses like that. But again, now you have to have records to prove all of these expenses, whereas last year it was just $2 a day, $500, no matter what you claimed as expenses.
Right, exactly. Okay, now I understand that there is an opportunity for first-time home buyers with the first home savings account to save for a down payment.
Yeah, actually, this is a pretty good deal. It's very similar to an RRSP. You can put up to $8,000 a year into this first homes program. and up to a maximum of $40,000. If you take that money, well, so it's sheltered from tax, so you don't pay tax on it while it's in there. When you take it out, if you buy a house with it, you don't have to pay tax on that money at all, which is a really good deal, $40,000, with no tax on it at all. So that's a pretty good deal for a first-time homeowner, yeah.
And it's such a great way to save as well.
Exactly. You're saving
Wonderful.
on the tax as well as saving for a house.
Exactly. A kind of a win-win there, isn't it?
That's right.
Okay, so are there potential tax implications when you buy or sell a home? Speaking of home buying.
Yeah, there's some new ones that have just come out here. Like if you live in your house and you sell your house, there's no tax on that, at least currently. The liberals may change that, but at this point, there's no tax when you sell the house that you live in. But they're bringing in new rules against anti-flipping, where people will buy a house, they'll renovate it, and then they'll sell it. Now, you used to be able to claim the income that you would make on that as a capital gain. Well, capital gains tax treatment is better than regular income tax treatment. Now if you own a house for less than a year, it's going to be treated as income, which is taxed at a higher rate. So they're trying to discourage people from buying a house and flipping it. Although it's still a great way to make money, it's just not quite as good as it used to be.
Oh, yeah, that's too bad for sure. Yeah, so any tax advice then to landlords who rent out their basement or rent out another house?
Okay, so first bit of tax that I usually tell somebody that's renting either a part of their home or renting a house or anything like that is don't take depreciation, or it's called capital cost allowance, on it for tax purposes. Because what happens is when you sell a house, typically in the future, you're going to make a capital gain on it, which may bump up your tax bracket already by doing that. And then most houses don't lose value, they gain value for the most part. There are situations where they might lose money, but for the most part, they gain money. So then you have to reclaim all of that depreciation that you've taken over the years. When you reclaim it, it's taxed as regular income. So it could put you in a really serious tax situation, we'll say, if you do that. So that's the first thing. Second thing that I want to talk about when it comes to renting out a house, make sure you claim all your expenses. You're allowed to claim the property tax that you pay. You're allowed to claim any of the expenses that are legitimately towards the house. So make sure you claim them. I've had people forget about their insurance or something like that. And so you give them a phone call, remind them, and then they have to go search for it. But the fact is, claim the expenses that you're allowed to keep your income as low as possible.
Okay, great advice there. Let's talk about charitable tax donations. How beneficial is this? How much would it save on your taxes?
Uh, Actually, probably one of the best things that you can do is donate to a charity when it comes to tax treatment. The only thing that's maybe better than that is if you donate to a political party, but the politicians take care of themselves. But for a standard donation to a charitable institution, a church or something like that, the first $200, you're going to get a 15% tax write-off on that. But anything over that, it jumps up exponentially. For example, anything over $200 automatically goes to 39%. And then if you get into the really high brackets, you can actually get, it goes to 29%. If you get into the higher tax brackets, it could go to 33%. So anything over $200 at the 29% rate, you may not even be paying 29% because you're not in that marginal tax bracket. So there's actually a really good advantage to giving to charity.
Yeah, no kidding. We were talking about write-off expenses before about how, so what about childcare? Can we deduct childcare expenses from our income?
Certainly can.
Okay.
Yep, and it's a very good write-off. So again, if you're paying a daycare or something like that, make sure you keep your receipts. Make sure you turn them into your accountant so that they can claim it on your tax return as well.
Okay. How about moving expenses?
Moving expenses, yes, with some caveats there. You have to move for business, and pretty well you have to move out of town. You have to move to another town. But if you do move, again, make sure you keep all of your receipts, and not just for the moving company. Make sure you keep kilometers for the trip that you did in your own personal car, because you can claim that. If you have to stay in a hotel, make sure you claim the hotel bills. All of those type of expenses can be claimed, and again, that's going to reduce your taxes for that year. But it has to be a move for business.
Right. Oh, great advice there. Okay, so Kent, is it worth keeping medical bills to claim as a deduction?
Well, the deal on medical bills is you can claim anything over 3% of your income. So there's this limit on it. So, for example, if you just calculate, say you made $50,000 times 0.03, you would have to have more than $1,500 worth of um, tax receipts before you can claim anything. So for the average person, $1,500 worth of medical expenses is quite a bit. But again, if you are a senior, then it's well worthwhile, keeping them because your income's lower, eh? So again, it depends on your income. It's 3% of your income, whatever your income is. So you want to make sure that, but keep them. If you buy glasses, a pair of glasses right now could be $800, right? And you
Exactly.
never know what other expenses might come
Yeah,
up
it
during the
could really
year.
add up to that. And I mean, before you know it, there you go. And by the way, Kent, how long should a person maybe hang on to their tax documents for?
Well, legally, you're required to hang on to them for 6 years, but you also need to keep your current years. So it's really 7 years. And then you can throw out anything. But the other thing about taxes is actually your tax returns are statute barred after 3 years, which means Revenue Canada can't open up a tax return that's more than 3 years old unless you ask them to. So if you ask them to open it up, or if they find that you've done something illegal, then they can open up going back further. But really, for the most part, they're not going to go back more than 3 years.
Okay. What advice do you have for someone thinking about investing in an RRSP or a TFSA?
Well, first of all, balance the amount between the two. I used to be really real promoter of RRSPs until I went to a seniors home and talked to some of the seniors that were in there, and they had subsidized rent in this particular seniors home. So as soon as you take money out of an RRSP, it becomes taxable income, and in that case, it raised their rent. So these guys, right off the bat, a third of it was going in tax. Then a third of it there was increasing their rent. So in the end, they didn't like RRSPs at all. But that's a rare case. For most people, an RRSP is good. What you have to remember is that it defers tax. It doesn't eliminate tax. You pay the tax, you just pay it down the road. On the TFSA, what I love about a TFSA is that you put money away, you don't get a tax bump right at the beginning, but any money that's earned in the fund is tax-free. And when you take the money out of the fund, it's not going to affect your taxable income. So again, if you're a senior, you take some money out of your TFSA, it doesn't increase your taxable income. If it doesn't increase your taxable income, it doesn't affect things like the GIS or your OAS or any of the other pensions that you might be receiving. So there's a
either pay
benefit to both of them.
you either pay now or pay later, depending on which
Yeah,
one
it's
you
sort of
choose.
like the old car commercial where they talked about an oil filter. You can either pay me now or pay me later,
Either
but
way,
you're
you're
going to
going to
pay
pay.
taxes. The only things in life that are for sure are death and taxes, right? So
Exactly. Okay, so if a person normally receives money back from the government after filing taxes, I understand that you can request a reduction in the tax withheld from your pay so that you can have less taxes deducted from your paycheck the following
yeah,
year.
this is really true, and it certainly applies to people who are very charitable. They give a lot of money away. So what you can do is after you've donated quite heavily for a year, Revenue Canada then has a record that you're a regular donor. And so you can send them a letter in year 2 and say, I'd like to reduce my taxes at source based on the charitable giving that I do. They will then send a letter that you give to your employer, and your employer can reduce your taxes at source rather than having to wait for a whole year to get that tax return. So,
Wow. Lots of advice there, lots of great advice, and lots to think about for sure, especially during this tax season as we're all thinking about getting our taxes filed. Kent, thanks so much for being with us today.
thanks for having me.
Absolutely. Kent Prestage is the owner of Prestage Consulting and is also an instructor at Reeves College in Lethbridge. I'm Jeanette Roche on behalf of all of us here at Bridge City News. Thanks so much for watching.